Hi everyone. In this video, we will talk about Ind AS 115 revenue from contract with customers. So this is considered the most complex standard. Maybe let's try to make it as simple as possible. So first, let us discuss the core principle. It is based on the core principle that requires an entity to recognize revenue. We have to answer two questions now. One is when, another is how much. When it is in a manner that depicts the transfer of goods or services to the customer. And second question is what? How much? At an amount that reflects the consideration the entity expects to be entitled to in exchange for those goods or services. So first question is when and second question is how much, right? So in earlier accounting standards, it was like we have to recognize in either proportionate method or percentage of completion method. Likewise, there had been a multiple methods which created a confusion among the accountants. Now we have a clear-cut method that states that when an entity has to recognize the revenue, it has to recognize the revenue when the transfer of goods or services to the customers is being completed. So let's take a simple example. Let's assume an air conditioner is being sold. It has an invoice amount of rupees 30,000, for which out of which AC constitutes rupees 20,000 and servicing constitutes rupees 3,000 and warranty constitutes rupees 7,000. Okay, so whenever an invoice is being raised, the transfer of AC is being completed while servicing and warranty is for 2 years down the line, so it is not completed. So we will pass journal entries stating that bank account debit 30,000 to sale of AC account 20,000 being the revenue component, to unearned service income account 3,000 to unearned warranty income account 7,000. Both these unearned service and warranty income is similar to the concept of income received in advance, which we earlier had in our earlier accounting standards, right? So income received in advance. Income received in advance is kept as a liability in the balance sheet until the corresponding revenue is being recognized. So at the end of first year, when the servicing is done or the warranty is being claimed or it is completed, then the corresponding portion of that service and warranty income will be transferred to the revenue. For example, to make it simple, let's have the service and warranty period as 2 years. So at the end of first year, we will pass a journal entry which states that unearned service income account debit 1,500, unearned warranty income debit 3,500, to service income 1,500, to warranty income 3,500. So to achieve this core principle, what is the core principle? To recognize the revenue and which answers two questions: when and how much, right? An entity should apply following 5-step model. What is the 5 steps? Identify the contract with the customer. What is being treated as contract in accordance with Ind AS 115? We will deal it later. Okay, on the go. Then identify the performance obligation. Determine the transaction price. Allocate the transaction price to the performance obligation. Recognize the revenue as and when the entity satisfies the performance obligation. To repeat, identify the contract with the customers, identify the performance obligation, determine the transaction price, allocate the transaction price to the performance obligation, recognize the revenue as and when the entity satisfies the performance obligation. So in our given example, identify the contract with the customer. For example, the sale of air conditioner here would be the contract with the customer. Identify the performance obligation. What are the performance obligation here? Sale of air conditioner, servicing service, warranty service. These are 3 performance obligation. Then we have to determine the transaction price. Transaction price is nothing but the invoice amount. Let's keep it very simple, okay? Transaction price is the invoice amount. What is the invoice amount here? It is rupees 30,000. Allocate the transaction price to the performance obligation. We have already done it, right? For AC, it is 20,000. Servicing, it is 30,000. And warranty, it is 7,000. Then recognize the revenue as and when the entity satisfies the performance obligation. When the sale of AC has occurred, we have recognized the revenue to the extent of 20,000. At the end of first year, when servicing and warranty component also being satisfied, we have recognized servicing revenue to the extent of 1,500 and warranty revenue to the extent of 3,500. So let's move on to step one which states the identify the contract with the customer. An accounting contract exists only when an arrangement with the customer meets each of the following criteria, which means that all the below five conditions are to be satisfied in order to qualify the step one. Okay, what are the five conditions? Have the party approved the contract? Approval here would mean either it could be an oral approval or a written approval or an implied approval, or as long as the party intend to bound by the terms and conditions of the contract, which can be like a written agreement could be like we have a stamp paper and we both sign and approve it. Oral could be we have been oral agreement to transfer the goods or services. Implied could be in if we take on a bus, we have to buy the tickets, right? So that is an implied agreement. So have the parties approved the contract? Approval is a must in accounting concepts to make it as a contract. Okay. Second one, can the entity identify each party's regarding rights regarding the goods or services to be transferred? For example, if we have a painting contract, the painter's right is to paint the entire house and to receive the amount, and our right would be like we have to pay only when the painter has completed the entire service. So both the parties' right has to be identified and it should be clearly identified. Third condition is that can the entity identify the payment terms for the goods or services to be transferred? For example, it could either be on-spot payment or 30 days payment or 30 days payment with discount or 6 months payment with financing interest or 2 years down the line payment with adequate financing interest. So the relevant payment terms have to be identified. That fourth condition is that does the contract have a commercial substance? Commercial substance here would mean the genuineness of the transaction. For example, if I being a customer a shop and purchasing an AC, there would be a genuineness in the transaction. On the other hand, if a Raymond shop dealer A, okay, Raymond brand dealer A transfers these shirts of similar quality to Raymond shop B, dealer B, then there is no actual commercial substance. So the accounting standard says that the such transaction should not be recognized as there is no commercial substance, because both the t-shirts which they are exchanging is of similar brand and similar quality, and there is no point of being entering into the sales transaction except for to increase the book sales, right? So that's why that doesn't have a commercial substance. And then the last condition is that is it probable the entity will collect substantially all of the consideration to which it is entitled to in exchange for those goods or services that will be transferred to the customer. This means that whenever I enter or provide any service, I am eligible to receive that part of consideration which I am entitled to. Am I right or not? Yes. This standard tells that if it is highly probable that you will receive the entire consideration, then go on recognizing the entire consideration as a revenue, or probability and I recognize only to the extent of that amount. Okay. So now, if all these five conditions which are as underlined, have the parties approved the contract? Can the entity identify each party's rights regarding the goods or services? Can the entity identify the payment terms for the goods or services to be transferred? Does the contract have commercial substance? Is it probable the entity will collect substantially all of the consideration to which it will be entitled to in exchange for those goods or services that will be transferred to the customer? If all these five conditions are satisfied, then we can move on to step 2 in assessing the rest of the conditions of the 5-step model. Okay, if not, this five conditions or one of the five conditions are not satisfied, then what should I do? I should check two more conditions. Okay, I have to check whether the entity has completed all of its performance obligation and doesn't have any other performance obligation to be left to be fulfilled, and it has substantially received all the consideration and such consideration is non-refundable. If it is yes, or the contract has been cancelled or terminated and that part of that has been received is non-refundable. If either of the five, if all of the five conditions, or the entity has completed its performance obligation and the consideration received is non-refundable, or the contract has been terminated or cancelled, or the consideration which has been received as non-refundable. If either of these three conditions has been fulfilled, then we can recognize the revenue. If not, we have to keep this consideration which has been received as a liability until each either the five conditions are satisfied or either of the other two conditions are satisfied. We have to continue reassessing these step 1 until these are fulfilled. Okay, once it is fulfilled, we need not reassess step 1. We can just move on to step 2. Okay, we have certain notes to be considered now. If at the inception of the arrangement itself we conclude that none of the criteria would be met, then we have to continue reassessing until step 1 is being fulfilled. Once step 1 is fulfilled, you need not come back and reassess until there is a substantial change in the environment or the facts and circumstances. Then the third note is that to generally what we will do is that we will account each contract as a separate contract, but there could be a cases where the contracts has been entered into at the near or at the same time with the same customer related party. For example, I have entered into a contract on 30th of January with ABC Limited. Then I am also entered into a contract with on 30th of January with BCD Limited, which is a subsidiary of ABC Limited. Then it is I have entered into a contract in on the same time with the same customer or its related party. Like ABC Limited and BCD Limited are related party, right? So this two contracts can be considered as a single contract when it has to fulfill either of the three conditions, which means one of the three conditions is fulfilled, then single contract. The contract are negotiated as a package or a which is based on a single commercial objective. Like I have to produce and sell you 1000 units. If it is negotiated as package with a single commercial objective, and I have to produce and deliver 1000 goods to ABC Limited and BCD Limited at so and so price. Okay, that is a single commercial objective. Or B, the amount of consideration paid in one contract depends on the price or performance of the other contract. Since I already have the contract with ABC Limited, BCD Limited will also ask me to produce at a discounted rate. So the otherwise he will not give me that contract, right? So the amount of consideration paid in BCD contract is dependent on the price or performance of the ABC Limited contract. Right. So this also can be treated as a single contract. Then the goods or services promised in the contract are a single performance obligation. For example, I have to deliver some goods as a single performance obligation, like we had AC, service and warranty. These are all part of single performance obligation that could be seen as a single contract. If I'm going to deliver similar goods to at multiple quantities, okay. So the same thing has been described in a table format now, okay, and flow chart format. Let's read it out. An entity is recognized to act on the near or same time and meet any of the following, whether it is for single commercial objective, if yes, it is a single contract. Whether the price of one contract depends upon this consideration of one contract depends upon the price or performance of the other contract, if yes, treated as a single commercial objective. Goods or service promised in one contract or both the contracts are treated as a single performance obligation, even that is also S, then treated as a single commercial objective. If none of the three conditions are fulfilled, then you may treat it as a separate contract. Okay, now we will take a practical example to understand this, whether it is a combining contract or a separate contract. So I operate a buses. Okay, so I now get a tender to operate five different routes from a government. Okay, it states the tender order states that I have to take the five routes, three of which will be profit making to me and two of which will be loss making to me. And I can either take the five routes as a whole, or I have to leave the five contracts. Okay, so this here, I am going to take the two contracts, loss-making contracts, only because I'm also going to make three profit-making contracts. So it's going to be treated as a single commercial objective, and its price is also dependent on the other contract performance obligation. So now, since all the conditions satisfied in this, either if one is also satisfied, we will treat it as a separate contract. Here all three conditions are satisfied, so I'm going to treat it as a single contract. Okay, this is a combined contract. This is the case of combined contract instead of separate contracts. Okay, yeah. And then accounting for modifications we'll take up quite later. Okay, after we complete step 4. Now, moving on to step 2, identifying the performance obligation. A contract with promises that may be implied by business, customary practices, or published policies, or specific statements which are given by the entity at the time of entering into a contract. Which, okay, here performance obligations are those which create a valid expectation of the customer when entering into a contract. Okay, so what I expect, if I buy a refrigerator from a company, I expect them to provide me a doorstep delivery. Okay, that is a business customary practice. I expect it. So that promise of buying an refrigerator creates a valid expectation in the minds of customer that if I buy a refrigerator, I will get a free doorstep delivery. So that is also a performance obligation. Okay. Generally, it need not be explicit or it can also be implicit. Okay. Type. Performance application has been defined in Ind AS, okay, which as under. It is a promise. It is a promise. It is a promise in a contract with the customer to transfer to the customer either goods or services that are distinct or series of goods or services that are substantially the same and have a same pattern to the customer. For example, see, distinct is just it is separately identifiable. Just understand that distinct means separately identifiable. Series of goods are substantially same. For example, if I'm going to deliver a newspaper, I have obtained the newspaper subscription, so that it means that I'm going to get newspaper for every 365 days without any delay. So it is a series of distinct goods or services that substantially it's the same, okay, and have a same pattern of transaction. Every day I'm going to receive the newspaper before 8 a.m. at my desk, right? So that has the same pattern of transfer to the customer. So let's understand distinct term more clearly. Okay, distinct includes a customer. It means that customer can benefit either alone or with a readily available resources. For example, okay, if I have the Apple iPhone, if I purchase an Apple iPhone, I can use it either alone or I can also buy its sockets and the charges from the rest readily available resources. So I can either buy it separately and use it alone, or I can also buy the charges and sockets to use it. That is our readily available resources. Okay. Readily available resource is nothing but which has already been purchased by the customer, or it can be purchased separately by the customer. Okay, it's clear. It also includes separately identifiable from the other forms of the contract, which means significant integration is not provided. All the three performance applications not integrated. Okay. For example, in the AC case, it is not significantly integrated, right? And in the assembly of bike, if I have to pick up each of these different things and I have to provide a customization, then it is significant integration is provided. And in the case of painting, I don't have a separate customization. Just it's a paint, unless it's an interior work, it's just a paint, right? There is no significant customization. But if I have to get a customized SAP or Oracle software, then significant customization is included. So if I get a 3 or 4 performance applications, those will be treated as combined, not distinct. Okay, then not highly dependent. For example, if normal call, if I can make with if I have a balance in my phone, right? That doesn't require a data connection. So both are not dependent on each other. But if I have to make Wi-Fi calling, both are interdependent. I have to have the proper network and also have the in this, if I have to make a call, that is dependent on the Wi-Fi connection. Okay, that is interdependent. Okay, so separately identifiable should be distinct, separately identifiable. Separately identifiable should not be dependent on one or more other things, or it should not be more customized, and it should not be in such a way that significant integration is provided. Okay, till this I hope it is clear. So let's have some key terms. Okay, promise to transfer goods or services. It means for a newspaper or a milk subscription. I have already discussed, right? You have in the case of newspaper subscription, you will get on the newspaper every 365 days, and the consumption pattern is also so similar or symmetrical, right? So it will be treated as a single performance obligation. If there are multiple elements or arrangements that the services are not distinct, then also we will treat it as a single performance obligation. So in the case of see Wi-Fi calling, Okay, there are no okay, or else we will have a case of customized JCP. We have multiple elements, so that is not distinct, but multiple elements are provided. Then what we will do, we will consider it as a single contract until we can identify a distinct component. In some case, if we can, if we are able to identify a distinct component, we'll separate that around as a distinct contract and keep rest all as a multiple element single contract. Okay, it's like a case of goodwill which we used to separate, right? In case of goodwill, what we will do, we will possible to the smaller CGUs, and if it's not possible alone, then we will move on to large CGUs. Likewise, if in the smaller cases, case of distinct, since I'm not able to allocate to distinct elements, I combine the entire thing as a larger one and treat it as a single performance obligation. I hope it is clear now, right? Okay, let's move on to third one, customer options for additional goods or services, which means that if there is a material right provided to the customer, which that option would be treated as a separate performance obligation. Okay, uh, the customer would not, okay, the right is material if it results in a discount that the customer would not receive without entering into the contract. For example, I say that if you use the HDFC card, okay, HDFC card within this period of time, you will get a additional discount. Okay, if he doesn't use that option, there is a material right till particular period of time. If he doesn't use it, then it is not a material right. Okay, the material right has been expired. If the option provides a material right to the customer in effect pays the entity in advance for the goods or services, then you can recognize the revenue when those future goods or services are transferred or when the option expires. Okay, assume here. If I have the goods sold to the customer worth rupees 100, okay. If he uses some HDFC debit card or credit card, he will get a discount of rupees 10. Okay, that is available till 31st of January. Okay, so when I will recognize the revenue at 90 rupees for now. Okay, until 31st March. Once 30, till 31st January, if he doesn't pay, okay, on 1st February, I'll also raise the rest 10 rupees as my revenue because there is no further options available to the customer to pay at a lower price. Okay, then if the discounted price in the option reflects the annual price, here now let's take another example. For example, in the AC, first example we'll take AC. AC, what we had, the invoice amount is 30,000 and AC is 20,000 and servicing is 3,000 and main warranty is 7,000. Assume that even if I didn't buy the AC, the servicing will be available to me at rupees 3,000. This means that I have just made a marketing offer and I have not granted any material right to the customer. Right? Am I right? Because both standalone selling price of the servicing and the invoice amount of the combined service is also same. So there is no just a marketing offer and it doesn't have any material right which is given to the customer. Account warranty for 1 year exercises the option. If the customer exercises the option, you can account the service income, otherwise you cannot. Like the transaction price, the basis of relative standalone selling price. If the standalone selling price for the customer's option to acquire is not directly observable, here would mean does not have a standalone selling price. That is, it is not, there is no market price. Then you can estimate it. While estimating, you have to consider two things. One is that if even if the exercising the option customer will be entitled to be received and the likelihood, that is the probability. So probability and the discount have to be considered while estimating the standalone selling price. Okay, I hope this is also clear. Now let's move on to the next term. Long-term arrangements. Long-term arrangements, it would mean that okay, if I have entered into a contract for a 5-year period, I have entered into a contract with you for 5-year period, and at the end of each year, I have an option to discuss with you either to renew or cancel. Okay, at the discrete point of both the supplier and the customer, then there is no there is no point in recording the 5 years as a performance obligation. So what the standard says that it would be as equal to recognizing separate contracts for each year. Okay, if it is in such a manner that it cannot be cancelled throughout the 5-year period, then it will be treated as a long-term arrangement. Long-term arrangement in any case would be more than 1 year. Okay. Okay, let's take another example. If assume I have entered into a contract with you for 10 years, the first 5 years is non-cancelable and less on for each year can be cancelable. At any point of each year I can cancel. So for the first 5 years I will enter it as a long-term arrangement. Post five beyond 5 years it will be treated as a small fund year agreement. I hope this is also clear. And then when the consideration is fixed, the accounting generally will not change regardless of whether it is a single performance obligation or multiple performance obligation, because the amount is similar, right? The amount is fixed for 5 years. This is this amount, okay? So no matter what, if I enter as a single performance obligation or multiple performance obligation, it is doesn't have any monetary impact. That's why I will keep it as single amount. Then, moving on to the next topic of consignment arrangement. Consignment arrangement is a case that I have just merely delivery of the goods and the sale of effect occurs only when the customer accepts the transfer. Right. So when the goods are delivered, I will not recognize any revenue. Prudence principle. Pakka prudence principle. When the goods are delivered, it doesn't have a transfer. Transfer. Here the core principle is what? Transfer. So transfer has not yet occurred, it's mere delivery. So I will not recognize the revenue. So when the transfer is controlled, when it will happen? Only when the customer has accepted the sale. Only then the consignment sale would be fulfilled, right? So only by then the transfer of control would have occurred for the respective goods, and by that time I can recognize the revenue. Then versus agent. Principal means here we have to understand that the principal carries both the price risk and the inventory risk, while the agent only have to make discussions with the customer and make him buy the product. Okay, so when the entity is the principal, he has to recognize the revenue at the gross amount and commission expense is payable to the agent as an expense. And when the entity is acting as an agent, he can recognize only the net income, that is the commission or the commission of the entity, which is entity's fees, as the revenue component. Okay, like I have already discussed, like the principal here would mean the person who carries both inventory and the price risk. So that's what has been given as an indicator. So since we can at all time it's not possible to identify who is the principal and who is the agent, that's why the standard provides certain indicators to be checked whether to establish this principal and agent's relationship. So the principal is the person who carries the inventory risk, who has the discretion in establishing the price. That is, he bears the price risk and he's primarily responsible for the fulfillment of the contract. Even if the agent brings some customer, it is a duty of the principal to deliver the goods, right? So that is the principal. He has this the primary responsible for fulfilling the contract. So only if the three conditions are satisfied, he will be treated as a principal. Okay, then we move on to non-refundable upfront fees. It is an advance payment. Like we make, if we enter into any contract, we make an advance, right? For example, if we go into rent or assume we obtain a gym membership, okay? If we pay the initial non-refundable upfront fees, we will receive a welcome kit, right? And if it is an international roaming SIM card, we just get a SIM card and we have a right to use that SIM card for a particular period of time. Okay, if the fees is linked to a separate performance obligation to transfer goods or services, then recognize it immediately, which means for the gym welcome fees, I have to receive the welcome kit, which means that the goods or services has to be transferred immediately. Therefore, the recognition of revenue will also occur immediately. If in the case of an international roaming SIM card, the performance obligation occurs only when that party makes a phone call from an international location to the particular domestic location. So it is related to a future performance obligation. So when the future performance obligation occurs, you can, and the transfer of goods or service happens, you can recognize the revenue. This with respect to performance obligation, non-refundable fees. Okay, then we are moving on to third component, determining the transaction price. The consideration promised in the contract with the customer may include the fixed amount or the variable amount, or it can be both. Okay, we will determine the amount which cannot be cancelled, is non-cancelable or non-renewable. So those amount can be directly recognized as a revenue. So the nature, timing, and amount of consideration promised by a customer also affect the transaction price. What does this mean? The nature would mean whether the customer is going to pay as a cash component or by a way of exchange of assets. Exchange of assets will naturally require the fair value computation, right? So the nature would also affect the definition of transaction price. The second is timing. Timing would mean the immediate payment is to the amount to be recognized as an immediate payment will be different from the amount which has to be recognized as a 2 year down the line payment. Correct. I have to I have to discount that amount and recognize it today. So that involves discounting work. And then the third is the amount of contribution. Both these two have an amount of contribution, whether it is 1 lakh or 10 lakh, either maybe it affects it, right? So the transaction price here would include fixed transaction price plus the variable consideration. Variable consideration which is not constrained, not constrained mean which have you don't have any right, the amount will not be received. Okay, transaction price would involve the 5 components which I'm going to discuss now. One is significant financing component, variable consideration. What are the constraints in estimating the variable consideration? Non-cash consideration, consideration payable to the customer. Let's go one by one. Okay, significant financing component. Before that, we will understand what is a variable consideration. Variable consideration is that which varies with the occurrence of an event. For example, if I perform good, I will receive performance bonus. That is a positive variable consideration. While receiving the penalties for that is a charge for a non compliance, right? So that is a negative variable consideration. So penalties will be accounted as per the substance of the contract. If the penalty is inherent in the determination of the transaction price itself, then that shall form part of variable consideration. So at the time of entering into the contract itself, I know that this penalty will be incurred, then that will be a forming part of variable consideration. Then estimating the amount of variable consideration. The standard gives us two methods to estimate the variable consideration. The one is that expected value. The term expected itself makes us understand that it is an average, mean as mean average, right? So here it is a weighted average. What is the weight? Probability is the weight. Probability is the weight. So if we consider probability, then there is a chance that there is more than two number of outcomes should be there. So the standards clearly states that only when there is more than two outcomes, we have to use this expected value method. Then most likely outcome, only two outcomes. If there is only two outcomes, that is, if I know that I can make this 1 lakh performance bonus, if 90% I'm sure that I will make this 1 lakh, or else I'm 10% doubtful that I can make a zero bonus, then most likely amount which is that 1 lakh, I have only two outcomes. So single most likely amount will be treated as the variable consideration, and the entity should apply only one method consistently throughout the contract. Then moving on a third one, so refund liability. Recognize a refund liability if the entity receives a consideration from the customer and expects to refund some or all of them consideration to the customer. For example, nowadays we have this advertisement which states that you can use this bed for 100 days, and if you are not okay with the quality, then we will refund the entire amount. In such a case, till the 100th day, the entity which is selling the bed cannot recognize the revenue. Until that, it has to keep it as a refund liability. And such refund liability, if it is for more than one period, then it has to reassess at the end of each reporting period the probability of refunding, considering the probability of refunding. Okay, then constraints estimates of variable consideration. It includes the transaction price, some or all of the variable consideration estimated only to the extent that a significant reversal is not probable. So I'm quite sure, I have been into this business for past 5 years, and I'm quite sure the bed will not be refunded. That is, it will not come back. Okay, then I know that significant reversal is not highly probable. Significant reversal is not highly probable. Significant reversal is not highly probable. Then I will include the variable consideration. If I am just started into the bed business, okay, so I'm doubtful whether it will be returned or not. So it is highly probable that it can be returned, right? So I should not include in the variable consideration. That is, I should exclude from the variable consideration. Then reassessment of variable consideration. It's general principle for any financial asset or financial liability. At the end of each reporting period, I have to reassess. Okay, and then moving on to the next one. Sale with a right of return. If the customer has a right to return, so we are just sale on approval basis, right? We will just sell, and if we approve, yes, also can return. Okay, so here we will recognize the revenue only to the extent that, okay, we have the past practice and at least 10% of the goods will be returned. Then to the extent of 90% of the goods, I will recognize the revenue. Or in the other case, we are a business for the past 5 years, and to the extent of 70% it will be sales, and to the extent of 30 it can be a refund. Okay, so I will pass a journal entry, bank account debit 100 rupees to sales account as revenue recognition 70 rupees, to refund liability 30 rupees. Okay, am I right? Clear? This refund level is similar to the back case. Okay. And then I should also estimate and record an asset. What is the asset for? Whenever something is being returned to me and getting a refund, then that means asset is coming in, it comes back in. So that should be recognized in the carrying amount. Carrying amount will nothing be the cost of that particular asset. So be careful to recognize this asset at the cost of that asset. Okay, and this should be after deducting any corresponding recovery expenses. Okay, then here we have entity shall present the asset separately from the refund liability, which means that there is a no concept of netting off. We should present the asset separately and refund liability separately. Exchanges by customer of one product for another type of product cannot be considered as return. We just exchange the goods. There is no concept of returning. We are not giving any cash outside the business, right? So it will not be considered as a return. Then exchange return of defective products and getting a new product. Return of defective products and getting a new product will be treated as fulfillment of rather than new product return. Okay, it's like warranty service being given, and it will not be considered as refund liability. Till now it's clear. Then now we are going to discuss about warranty. Warranty, if the customer has an option to purchase it separately. In the case of AC, we have an option to purchase the warranty separately, right? So it is a distinct service. So we have to allocate, we have to make it as a separate performance obligation, separate performance obligation, separate performance obligation. In the case of an AC, we had warranty which is also can be provided by an outside person also. Therefore, it is a distinct service and it has to be accorded as a separate performance obligation, and that part of the transaction price has to be allocated based on a standalone selling price. Okay, the customer does not have an option to purchase it separately. For example, iPhone. I cannot purchase the warranty separately. I have to use that warranty which comes from the manufacturers. Okay, so that warranty provides an assurance that the product complies with the agreed upon specification. Whatever the specification that the manufacturer has agreed to provide us with, that is being an assurance. That is, warranty serves as an assurance. So it is similar. It has to be treated in such a way which has been stated out in Ind AS 37, which is provisions, contingent liabilities, and contingent assets. We have to treat warranty as a provision under that. Okay, then significant financing component. Any period which is greater than 12 months will be treated as significant. Okay, so for example, if I purchase an AC, down payment I have to pay 30,000. If I have to pay more after 2 years or 18 months, then I have to pay it as 40,000. Then this additional 10,000 is because of the financing component. Okay, what is the rate at which I have to discount it? The discount rate has to be known, right? The standards clearly says that it could either be an incremental financing rate, or if incremental financing rate could not be identified, then it has to be internal rate of return. What does incremental financing rate states? It states that incremental borrowing rate. If an entity go now and borrow the similar amount with a bank or a financial institution, what is the additional borrowing rate the company has to pay? That will be known as incremental financing rate. Okay, then what are three exceptions where it will not be considered a significant financing component? Okay, one is reasons other than financing. Reasons other than financing. What are the reasons that could be other than financing? Okay, I have a complex machinery which has been supplied to me by my supplier. Okay, I have made an agreement that the cost is rupees 10 crore. I agree. Okay, I will make you 7 crores down payment now, and 3 crores I will pay only after 2 years. I will check the quality till time. Okay, if there is no repair and no damages and made until 2 years, then I will pay you 3 crores. This is like retention amount, which is prevalent in many of the industries. Okay, retention amount is not a financing component. Okay, that's why it is excluded from the significant financing component definition. The exception too is that the transfer of goods or services is at customer's discretion. The customer has sole discretion for effecting the transfer. For example, I pay an advance amount, okay, and buy a 2 year SIM card, and I use money at the end on only the 24th month. Does the entity have any right over it? No. I have a sole discretion to use it from first month till 24th month. I use money at 24th month. The company cannot question me, right? So there is no significant financing component involved, just the customer discretion. And third exception is that the variable consideration. So I write, instead of giving this video lectures, I write this as an entire book and publish it. Okay, what I say that is that whenever the entity makes a sale, I say that I have to receive so and so rupees as my variable consideration, that is a royalty. So royalty here depends upon other than financing component, right? It is based on number of books sold. Okay, so here also it is an exception to the significant financing component. So customer paid for the goods or services in advance. The timing of the transfer is at the sole discretion of the customer. It is also an exception. And second exception is that the substantial amount of the consideration promised by the customer is variable, and the timing of amount of the consideration is not substantially within the control of the customer or the entity. That is a royalty. Okay. Then the difference between the promised consideration and cash selling price arises for reasons other than the provision of finance to the entity. That is, here it is a complex machinery case. Okay, I hope it is clear till now. Let's move on to the next part. Non-cash consideration. Measure the non-cash consideration at fair value. Okay. Okay, here we have to check whether the transaction have a commercial substance. In the case of Raymond dealer A and Raymond dealer B transaction, there is barter system. It is also a non-cash transaction, but doesn't have commercial substance. Since the original transaction was not recorded itself, there is no revenue recognition which should occur. If the transaction has commercial substance, then first the non-cash consideration has to be estimated using its fair value. Measured using its fair value. Otherwise, a fair value is not available directly, that is directly observable, then you can estimate it by considering similar goods standalone selling price. Okay, then subsequent measurement of non-cash consideration. If the fair value of the non-cash consideration varies after the contract inception because of its form, then it is not just transaction, because just assume that I have given you unassembled goods now. Okay, if I have assembled and given you, then it's mere form which has changed. The entity should not adjust the transaction price. Okay, if it is for other reasons, any other reason, the gold price itself has increased, okay, then I can estimate and change the fair value based on the guidance which is available. Okay, then consideration payable to the customer. Is this consideration payable to the customer for distinct goods or service? Distinct goods, okay, or service. Okay, what is the case here? In a mall, okay, you find a particular watch store. Okay, there will be separate for Apple watches, Samsung watches, or smart watches, or something. Right? For that Apple watch rack, the Apple company has to pay rent to the customer. Right? So if it is consideration is payable for distinct goods or services. If it is yes, then I have to check whether it is similar to the fair value of that service provided. If the rent is, if I charge the same rent both the Samsung company and the company, then what happens is that both pays rupees 2,000, assume. Okay, 2,000 both pays the rent per day. Okay, so that's as an exit the fair value, right? Therefore, you have no, if it doesn't exist, then you have to record this expense, record this as a separate expense, record this as a separate expense. Okay, no, you think because it's your customer, you pay them additional rent. Okay, you pay them 3,000. Okay, then you are providing some extra benefit to the customer, right? So up to rupees 2,000 is up to the fair value, can record as a distinct expense, and beyond that, the additional 1,000 rupees which you are paying, it should be shown as a reduction from the transaction price. Okay, if it is not for a distinct, just paying simply, then it is should be accounted as a reduction from the transaction price. I hope till this it is very clear. Now, moving on to step 4, allocating the transaction price to the performance obligation. In the first case, what we did, we have allocated the invoice amount of rupees 30,000 to each service component, warranty component, and the AC component. That is allocating the transaction price to the performance obligation. So it has to be done on the relative standalone selling price basis. Except, what are the exceptions? Allocating the discount and allocating the variable consideration. So first we will discuss what is how we have to determine the standalone selling price. Standalone selling price will be known as the observable price, that is market price of the particular goods or services which is being sold to a similar customer in a similar circumstances. It can be used 3 methods. Okay, first one is that adjusted market assessment approach, which is like market price, direct market price, that is competitors price. Okay, And then the second one would be, if not you are not getting the market price, then you can go with expected cost plus margin approach, which means you have the already incurred certain cost and you have a general margin of rupees 20%. Then the cost plus 20% margin would form the standalone selling price. Okay. And then third method is a residual approach. Okay, if in a contract I have three performance applications, then for each performance application I can use a similar different methods. Okay, for one I can use market price, for the other one I can use cost plus, and for the third one I can use residual. But if I use for in one contract, if I use AC as market price approach, for every other contracts for calculating the standard selling price of AC I have to use the similar approach as market price approach. Okay, what are the key points that are to be discussed here? Before applying the residual approach, I have to allocate the discount individually to each product. Okay, then the value of under the residual approach should be within the range. What does this mean? For example, if I am into a business of selling a t-shirt within a week, I can during the weekdays I'll sell at one price, and during the weekend I will sell one price. Or else, for example, it can be the travels business. During the weekdays they have one price. During the weekends they have a peak pricing, right? So within that range it should be there. For example, if a ticket from Chennai to Madurai cost me rupees 1000 to 1500, that is the range. Okay, in even in the residual approach, if I apply that answer which I obtain should be within this range. Otherwise, I have to reassess again the discount and the individual standalone selling price of the other products. Okay. So yeah, residual approach should be like total transaction price. Okay, for example, I don't know the amount of warranty. Okay, so what is the total transaction price? 30,000 minus sum of standalone selling prices 20,000 plus service component 3,000. So net will be 7,000. That will be treated as a warranty transaction price. It will be suitable only if the entity has no standalone sales or very broad range of standalone selling prices available. As I had from 1,000 to 1,500. So that in that case, residual approach will be applicable. Then allocation of discount. Allocation should be allocated generally if it is not identified to a particular product, then we have to allocate it based on the standalone selling prices. When to allocate to less than all performance, when to allocate to less than all performance. So I know that if I deal with product A, B, C, and D. Okay. Now I give this all four products in similar package, same package. Okay. Then what happens is that even if the customer buys B product separately, I will give them 600 rupees discount, and C product separately, I will give them 400 rupees discount. And for the entire package also, I'm giving rupees 1000 as discount. So it is very close to the individual discount I provide, so that this discount should rationally be allocated only to product B and C and not to all the products based on the standalone selling prices. What being told here, if all because I regularly sell that particular B product at 600 rupees discount, and even in this bundle I'm giving a similar discount, so that it is directly observable using the evidence of individual sales, so that I'm going to allocate this only to B and C product, discount of rupees 1000 to B and C product in the ratio of 600 and 400. Okay, if I'm able to directly identify, then I have to allocate the discount directly. If I'm not directly identifiable, then only I apply that relative standalone selling price basis. Okay, then allocation of variable consideration. Variable consideration is also applicable if it is allocated to the entire contract or a specific part of contract. Okay, then how to allocate? Both of conditions are available. If terms of variable payment relate to specific entity's effort, okay, specifically for B product effort alone, I'm giving this variable consideration. That variable consideration have to be allocated to product B alone. And if it is an entire product or the entire performance obligation, then you have to allocate on some reasonable basis, that is standalone selling price basis or whatever it may be. We will before moving on to step 5, we will discuss that accounting for modification. We will move on here. Okay, let's go there, back. Accounting for modification. Now we that identify the distinct mean this should be separately identifiable. And standard selling price, that it could either be a market price, or it can be a cost plus price, or it can be a residual approach price. Okay, so accounting for modification. If both the following conditions are satisfied, then it will be treated as a separate contract. What is the conditions? The increase in this modification results in increase of rights and obligations, increase in the goods or service to be transferred. or and I'm sorry, and there's both conditions, right? So it's and the considerations will also increase in such a way that it matches for the stand-alone selling price. For example, I have to deliver you extra additional 100 units, and the stand-alone selling price will also be 10. There's no there's no, I didn't make any compromise, right? So both the performance obligation increases, similarly price also increases. Therefore, there is no compromise I make. Therefore, it has to be accounted as a separate contract. Separate contract. Okay. No, it's one compromise I'm making. Yeah, and the one thing is that it is closely similar to the products or services I have transferred on or before the date of are the remaining goods services distinct from the goods or services transferred on or before the contract modification. If I supplied some goods earlier, okay, and it is distinct now, what I'm going to supply is distinct, okay. Then if it is yes, you have to cancel the original contract, and you have to treat it as a cancellation of original contract and treat it as a creation of a new contract. Okay. No, reserves are not distinct. Okay. And it's partially satisfied. It is partially satisfied. For example, I have already entered into a contract of delivering 1,000 pens to you, and now you are asking me additional 500 pens, and you are also asking me to deliver all the 1,500 pens at rupees 9. Okay, what would have happened is that for initially I would have recognized the revenue as 1,000 into 10, 10,000 rupees. Now, since that you are asking me to compromise on the price, there is consideration which is already partly has been satisfied to you. Okay, then I have to use this catch-up basis. Catch-up basis, which means that to the extent of rupees 10, rupees 1 for all the 1,000 pens, I have to reverse the revenue. Okay. Understand? For 1,000, I would have recognized as 10,000. Now I have to reverse that 1,000 rupees. Okay. And this is known as catch-up basis. And last one, none of the concerns satisfied. Okay. It's not, nothing has been compromised. I'm not able to directly identify something, someone is distinct and someone is not distinct. Then for distinct products, follow distinct principles, and non-distinct product, treat it as a single contract and move further. Okay. That's what has been told. And now, we go into the last step of step 5. It's so simple. Okay. Complete it soon. Satisfying the performance obligation. Now that we have identified the transaction price, we have identified the contract, then identified the performance obligation, then also we have identified the transaction price, then also we have allocated the transaction price to the individual performance obligation. Now what is the pending thing? It is only to satisfy the performance obligation. Satisfy the performance obligation. When the satisfaction happens? Only when the transfer of control occurs. Only when the transfer of control occurs. This is what the core principle we have discussed, right? Revenue should be recognized only when the transfer of goods or services is being done. Okay, transfer of control would result in satisfaction of performance obligation, which will help us to achieve the revenue recognition. Okay, here transfer of control could be of two types. One, either it could be over a period of time, and the second one could be an at a point of time. Okay, at a point of time is not clearly defined by the standard. So it states that when it is not over a period of time, then it could be an at a point of time. Okay, so let's discuss over a period of time. Over a period of time, does the customer control the asset as it is created or enhanced? Does the customer control the asset as it is created or enhanced? Which means, for example, if I have appointed a painter to do a painting work, so till the extent we have done the painting, I am going to enjoy the benefit, right? Already I have the asset, land or building I have asked them to paint. So the customer, I already control the land or building, okay, and the painting is also being controlled by me. So directly control is transferred over a period of time. No, it is not. Okay, then he is asking me, does the customer receives and consumes the benefit as the entity performs, which means simultaneous consumption of benefit. Okay, for example, let's take a layman example. As your mother cooks dosa, what you will ask, you will just go and eat. Simultaneous consumption of benefit, just for fun. Okay. Here, a practical example could be, I'm going to use a gym for 3 months, okay? And then a new trainer comes. Does that mean I have to start from first? No, right? I have already consumed the benefit till 3 months, okay? Right. That is simultaneous consumption of benefit. Another example could be like, I have been appointed as a faculty, okay? Some other faculty comes after 3 months. Does he have to take from right at the beginning concept? No. He can take from where I have left, right? The simultaneous benefit of consumption of benefit by the students, okay? Okay. If it's also S, then it's also not a control is transferred over a period of time. Okay, then other case would be when it, control is not transferred. For example, a new I have been appointed as an auditor of ABC Limited company. Okay, then a new auditor comes. Is responsible to perform the audit right from the beginning because he may have a different audit plan, different scope, or different audit risk, right? She does not have a benefit of consuming my works, correct? So here does not matter. Then he is asking, does the entity have an alternative use? Does the asset have an alternative use to the entity? For example, generally, example what can take here is, for example, satellite construction. I have been engaged in satellite construction business. Okay, satellite I have to assemble and give you. Okay, you do contractual or instructions, I will not be able to transfer this right asset to somebody else. There is no alternative use. Okay, then it is control is transfer over a period of time. For example, I'm just like I'm giving an asset of table and chairs. You can have an alternative use, right? Instead of if you don't need it for an office, you can make it to your home. Correct. So it has an alternative use. Then if it has an alternative use, then it control is transferred at the point of time. At the point of time. So whenever you say that control is not is transferred over a period of time, you have to also check does the entity can recover the amount to the extent the work has been fulfilled. Only if that is also a yes, you can treat this control as transfer over a period of time. Which means that if the end customer controls the asset is created or enhanced, or if the customer receives simultaneous consumption of benefits, or if the asset does not have an alternative use to entity, either of three conditions, plus the entity also have enforceable right to receive the payment till the work has been completed, this is equal to control is transferred over a period of time. Okay, if none of these conditions are satisfied, it will be treated as control is transferred at a point of time. Any of other scenarios will result in control is transferred at a point of time. Okay, for control is transferred at a point of time, we have to understand what is control right first. We have missed it, right? So control means I have the ability to direct the use of the goods or services. If I have a laptop, okay, I am responsible. I have the ability how it should be used, right? And if I have all, for example, if I have ordered a MacBook, okay, an Apple company, I don't have one, but if I assume I have ordered one to receive, okay, by a particular serial number, only I have the right to use it. Okay, and I also prevent others from using it. No other customer can use it, right? Only I can use it. I also have the ability to prevent others from directing use or obtaining substantial benefit. Okay, under the transfer of control at a point of time, the standard gives us 5 indicators. What are the indicators? It could be legal title or a physical possession, or customer has significant risk and rewards. Customer has accepted the transfer, or the entity has the present right to payment. Okay, if any of these five can be treated as indicators of control transfer. Okay, how are you going to measure the stage of completion in case of progress? If it's an output-based method, you will use the fair value. Like, what are the two methods to consideration? What are the two methods? We have three methods, right? The residual value we'll ignore for now. Okay, two methods are there. One is that fair value, another one is cost plus some adequate profit margin, right? So output-based method is that fair value, and input-based method is that cost method. Okay. Then what are the key points? Generally, in accounting standards or the costing principles, we will ignore the abnormal loss or wastages to be incurred in the cost incurred, right? That's what is being said here also. Exclude abnormal wastage. And if you have just purchased the material, but you have not used it in the product, will you charge the customer for that product? No, right? For the material? No. So, major materials which has merely been purchased and unused, you have to adjust the input for those okay, then now three more concepts. Okay, one is repurchase agreement. Will complete its own repurchase agreement, contract cost, and service constant arrangement. First, repurchase agreement. A repurchase agreement means I have sold you something and I have made an agreement to repurchase it from you. Okay, the standard believes there is something missing here, some link is missing here. So he asked us it should be classified into three things. One is forward, one is call option, one is a put option. Forward is that entity have an obligation. Entity has an obligation. It's a liability. Entity it's liability to purchase the asset. Repurchase the asset. Okay. If it is a call option, it's a right to repurchase. It's just a right. we have certain SFM right. It's just a right, but there is no obligation. They not purchase, but it's a right available to the customer. Okay, then the NLS obligation to repurchase asset at the customer's request, put option. Okay, it is a right, right? So if the customer has repurchase, if a customer request, you have to repurchase. Okay, then forward option. If the repurchase price is greater than the sale price, it is greater than the sale price. What you have obtained is financing. Okay, you have just obtained a loan. Okay. Okay, you've sold at a lesser rate and told him to give a higher amount. Okay, just a loan. Okay, then repurchase price is less than sale price and it's a lease. Okay, for the options, similar treatment will be exercised. Okay, only when it is likely to be exercised. If it is highly probable, you will use a similar treatment. Okay, then moving on to contract cost. Contract cost could be two things. One is contract acquisition, one is contract fulfillment. Any cost which is incurred to acquire the contract, you have to recognize as an asset if it is reasonably probable that it will be recovered. Okay, where you have believes that you will be able to recover, you are expecting to recover that amount, then you will recognize the additional incurred cost for contract acquisition as an asset. Okay, that's the receivables. Okay, and contract fulfillment. Contract fulfillment are those costs which are incurred to fulfill the particular contract. This will be recognized as an asset only if it is directly linked to a particular contract and it enhances the useful life or the value of that particular asset generated, or it helps in satisfaction of the performance obligation, and it is quite probable that this will be recovered. Only if all the three conditions are satisfied, then you will recognize an asset with respect to contract fulfillment cost. Okay, let's repeat. Only if all the conditions are satisfied, one, it should be directly related to the contract. It should generate or enhance the value of the resource or help in satisfaction of the performance obligation, and it is highly probable that it will be recovered. Then service concession arrangement. So last concept, let's discuss it and leave. Okay. Then service concession arrangement. For example, the best example would be the toll roads. Okay, toll roads may just have a right to collect a certain amount. Okay, but we don't have an ownership over the toll road. Right, government has the ownership. The entity doesn't have an ownership towards the toll roads. Okay, so this means that it cannot be classified as a property, plant and equipment. For an asset to be classified as property, plant and equipment, the entity should have the right of ownership. Right of only if there is ownership, that particular asset can be classified as a property, plant and equipment. So okay, now it's sure that it will not be classified as property, plant and equipment. Then how else we have to classify it? To the extent the entity has an unconditional right to receive cash, it will be treated as financial asset. Financial asset means in the AS, financial asset would mean any asset which can be converted into cash, which can be recovered as cash. Okay, that will be known as financial asset. Okay, ma. In this case, generally what happens is that the government pays you certain amount initially as a bulk amount, and later on the remaining amount you have to recover as a toll charges. Right. The unconditional right which has been exercised by you to receive the initial bulk amount is known as financial asset. Okay, then the right to collect toll. It is a right which is given to you, but you are just acting as an agent. You are not a principal because you don't have the you cannot determine what the toll prices could be. The government fixes a toll price, right? So you don't bear the price risk. Therefore, you are acting as an agent. Therefore, it's just an intangible asset. A right to collect toll is just an intangible asset which is available to you. Okay. With this, we also complete all the topics which is being there in Ind AS 115. Feel free to ask any doubts if it's there in the comments, and please do like and share with your friends for better reach. Thank you so much.